What's good, everybody? Doug Washington here, and I want to personally welcome you to my YouTube channel where I discuss everything from personal credit, business credit, travel hacking, literally everything pertaining to financial literacy. So on today's episode, we're going to be breaking down how I went out and amassed over 7 figures in funding. And actually, to this date, I have around 2.3 million in funding between my personal lines and my business lines. And I want to show you the blueprint on how I was able to obtain that. So before we jump into anything, I just want to let you know that I am Doug Washington and I do two things. First and foremost, I ensure that everybody eat. And secondly, I make the banks compete to lend you money. So on today's particular episode, we're going to be breaking down what you need to do to get your first 7 figures in funding. And I know you may be thinking, Dub, like that is not possible. I'm here to tell you that it is very much possible, as I came from a 426 credit score in 2016 to well over 800 now. And once again, currently at the time of this recording, around 2.3 million in funding. And actually what I have structured to close out 2025, going into 2026, trying to get around 3 million in funding to close out the year. But once again, I'm going to be breaking down how you can get your first 7 figures in funding. So listen, man, I appreciate you for tapping in, and let's jump into it. So first and foremost, the number one thing that you want to do whenever you are structuring your $1 million portfolio is just to understand that banks will judge you basically what you have on your profile. True comparables is what's going to get you large lines. And as I get into the training today, I'm going to be breaking down pretty much my opinion on credit builder accounts. For starters, I don't necessarily like them. I'm not saying that they don't work, but I'm thinking in terms of longevity. You don't want to add too many credit builder accounts, as this essentially just tell other lenders that you are in the process of either rebuilding or you just came out of credit repair. So as we jump into that, I'm going to be giving you some solutions outside of going with the particular credit builder accounts. So first and foremost, we got to position our personal profile, and this is structuring with true comparables. You want to build solid comparables, family. I want y'all to really understand that part. You want to build solid comparables, and whenever I say comparables, these are quality lines. And not only do you want to have installment lines, you want to have revolving as well. So once again, you are mixing installment comparables with revolving comparables. These are for installments, these are auto loans, these are mortgages, personal loans, student loans, anything that's going to require you to make the same exact payment over a significant amount of time. And whenever you are getting your installment loans, the true rule of thumb is to always hold them for minimum 8 to 12 months before you pay them off. So if you have a $20,000, $30,000 personal loan, you want to actually hold this loan for 8 to 12 months so you can get those quality accounts as paid as agreed, even once they're closed. Also, outside of the installments, you want to make sure that you develop some quality revolving lines on your consumer report as well, as we are talking about credit cards. These are lines of credit, etc. Like this is going to be very, very key in building out your FICO bank card score 8, your FICO bank card score 5, your FICO bank card score 3 and 9, and so on and so forth, right? Because the type of accounts that you have on your profile will dictate what type of lending that you get. And not everybody is going for the same type of lending. Not everybody is going for credit cards. Not everybody is going for mortgage loans. So you want to have a great mix. So no matter what you're going for, you're able to get high lines along with a great APR. Next up, I want to really hit on this, and this is pretty much my opinion. I do not recommend store cards on your profile, as these are consumer issue versus bank issue, even though the underwriter will be from a particular bank. But the thing with store cards is that you can only spend them at that specific store. So if you get a Target card, you can only spend that at Target. If you get a Victoria's Secret card, you can only spend that at Victoria's Secret, right? But if you get a bank issue product, such as a Capital One, a Discover, or even, I'm going to get into it more later, but let's just say you even go and get an upgrade card. You can spend these particular types of credit cards anywhere that credit cards and cash is accepted. Now, whenever you get store cards, you're only going to be able to spend them at that particular store. You see what I'm saying? So make sure that you do not add any store cards to your profile in 2025. My next thing that I want to definitely talk about is secured products are even better than store cards. Because whenever you get a secured product, this insinuates that you have liquidity or capital to put up to front the bill, right? So whenever you're going into an institution and you want to pretty much prove yourself ahead of time, one of the best ways is to go and open up a secured product with them, whether it be a shared secured loan or certificate pledge loan, whether it be a secured credit card. All of these are going to be great with building internal bank ratings with each particular institution, whether it be a credit union and or a bank. So as you're going through, just take this into consideration before you get those store cards, that it may be a better solution for you to go out and get access to a secured credit card with you putting the money up front to prove yourself. Now, you can take the next 6 to 12 months, family, to structure $1 million sequence. I'm gonna say that again. You can take the next 6 to 12 months to structure $1 million sequence to where once you get these internal bank ratings, once you understand the application rules, once you understand when to apply for certain credit cards, in which we're gonna get into all of that good stuff today, you can really put yourself behind the 8 ball and in position to run up your first 7 figures in funding, right? So one of the great products that you can do, since we're talking about internal bank ratings, is the certificate pledge loan, also known as a shared secured loan, also known as the Navy Federal pledge loan, right? And I know a lot of people know Navy Federal for this, but there are thousands of institutions that pretty much offer the same exact product with higher limits. Now, whenever you are going to get these certificate pledge loans, you need to make sure that you understand the internals behind it. How do they lend it out? Now, if you go through, and I'm going to explain the play here shortly, but if you go through and you pay off 90% of this loan, you want to ensure that on this secured loan that you put the money up on, you want to make sure that they're going to release the money back to you as you pay the balance down. You don't want to have to wait to get the entire amount back once the full amount is paid off. Now, what you want to do, let's just say you have $10,000 sitting in your savings account. Now, you go out and you say, hey, I would like to take out a shared secured loan against my savings amount. So you have $10,000 sitting in this account. Whenever you apply for this brand new product, what's going to happen is they're going to withdraw the $10,000 from your savings account and they're going to put it up as security. So you're going to apply for this certificate pledge loan. They're going to withdraw the money from your account to see that you actually have the capital. Now from there, they're going to issue you a $10,000 shared secured loan in your personal name for your personal profile. Now from here, this is the key. You want to pay 90 to 95% of this shared secured loan down, because this is going to basically put you 2, 3, 4 years ahead of having a payment. So they release the money back to you. You put $9,500 or $9,900 towards this payment, and they're going to withdraw the money from your account, hold it on the reserve 24 to 48 hours, and then they're going to release it back to your savings account. Now, what's on your profile is a $10,000 primary comparable that you can use to go out and get future funding. Now, we're building internally here. The next step would be to run the same exact play again, but with a different amount. So you started off with $10,000. Now you ran it for $10,000 with one shared secured loan. You could then come back and do it for, let's just say, $7,500. You run through the same exact steps again. So and instead of paying the full $7,500 down, what you want to do is pay about $7,000 on it. You want to leave a small balance on this because you're essentially building out a payment history for installment lines, right? Now, why you don't want to do it for $10,000 twice is because the other institutions or other credit unions, banks, etc., they may look at this as a duplicate account if you do it with the same issuer. So what we want to do is do one loan for $10,000. Now we're going to do another loan for $7,500. What you have now taken and did was take $10,000 of liquidity and you built out $17,500 worth of comparable lines. Now, listen, this is where it really gets good. This is how I make the banks compete to lend you money, family. We're then going to do it a third time if that institution allows it. Some institutions will only allow you to do 2 certificate pledge actively at one time. Some will get up to 3, some will go up to 4, but you have to do your due diligence and your research to ask these questions with whatever institution that you are intending on building with, right? So now with Navy Federal, you can do it 3 times. So now what we're going to do is we're going to go back again with the same $10,000 in liquidity, and we're going to get a $5,000 comparable on our profile. Now, what you have done, family, is created 3 comparables on your consumer report. That's an installment line. And not only to mention that you took 10,000, and if you do 10,000, 7,500, and then 5,000 on another line, you have now created 22,500 with $10,000 worth of liquidity. But what the other institutions are going to see is that you took out 3 separate loans and you have a 90% paid off. Now, let me explain why you want to pay it to 90% and then you want to extend your date out. Whenever you pay the 90% on the actual loan, it's going to extend your payment out, because whenever you sign up for a loan, they break it down into payment periods. So as each payment period goes, it's going to be breaking down for the term of the loan. If you pay off 95% of it and you have a 4-year loan, you have extended out your first payment to be due 3 to 4 years from now. So this is why you don't want to pay it off in full, because if you do, they'll close it and you will not get the consistent payment history on these accounts. This is one of the ways in which you could leverage liquidity that you have available to you to get access to more capital. So that's just one way. Now, while we're here, if you have not grabbed my $47 ebook bundle, it is in the description below, so you can get access to my $47 ebook. This is typically $279, but I'm going to be breaking down how to get a 700 plus FICO, as well as how to structure your business profile to make the banks compete to lend you money. So if you have not grabbed that, check the description below and take advantage of that $47 ebook offer. Now, as we develop more into a strategic breakdown, I got to discuss my 3-5-90 method, which has got me well over 7 figures in funding since I started my credit journey back in 2021. So my 3-5-90 method that I break down is that you go to 3 to 5 banks every 90 days, and you can do this per bureau. Now, only do this if it's within your risk tolerance. If you only can do 2 banks every 90 days, if you can only do 3 banks every 90 days in totality, do what works for you, family. But once again, the more banking relationships that you have and can handle, the more availability of funding that you're going to have in the future once you structure your funding rounds in these 90-day sequences. So my 3-5-90 method essentially breaks down how to go to 3 to 5 banks every 90 days. Is going to pull from individual bureaus. So if you go to 3 to 5 banks every quarter, that's going to pull from Experian. If you do it on the low side, this is a total of 12 banking relationships just for Experian. Now you're going to do the same exact thing for TransUnion and so on and so forth to Equifax. What you have now done was develop 36 different banking relationships over a year time frame. Now, with the information I'm going to be breaking down to you guys today, if you took available credit that you had on a credit card and got liquid with it to go and build future funding rounds by developing a deposit relationship. So it gets very, very interesting once you get into the $10,000, $20,000 mark with internal bank ratings. So whichever bureau is the strongest for you, family, I recommend that you start there with the banks and or credit unions that are going to pull that specific one. Now, I have a secret lenders list for $1, right? You heard that right. I have a $1 secret lenders list that's also in the description below that you can purchase. And it's going to break down what each individual credit union and or bank pulls from, and along with the FICO score that they're going to use. So once again, don't get caught up in just looking at your Experian, TransUnion, and Equifax, because banks will pull a different version depending on what product that you're going for. So my $1 secret lender list will break down all of this information to you so you know what banks will pull from who in your specific region. Now, once again, as I previously said, whichever bureau is the strongest for you, start with the banks and credit union that's going to pull from them. So if it's Equifax, if you are within Truist's footprint, you'll go to Truist and develop a relationship. If you are in Citizens Blueprint, you'll go to Citizens Bank and develop a relationship. If you're in Synovus's Blueprint, you'll go to Synovus and develop a deposit relationship with them. So wherever your strongest bureau is at, you should start with the banks and or credit unions that pull from them once you start your whole funding journey. Now, banks can pull different bureaus for lines of credit, loans, credit cards, etc. right? So you have to be sure to ask whenever you are auditing the bank. Another thing that I do very well is asking the right questions. Whenever you are developing a relationship with these banks and credit unions, you have to know their primary source of lending. You do not want to go to a bank that lends heavy on the personal side and then you're trying to go and get a business credit card with them and vice versa. You don't want to go to a bank that's known for lines of credit and then you try to get a loan with them, right? So you have to understand what particular form of lending that each institution will specialize in. And I talk about more of that in my mentorship. And if you want to join that, just drop mentorship in the comments and then the team will take care of you. Also, based on the location where you apply from could determine what bureau that they pull. So TransUnion may have a specific set of banks that may pull from you if you are in the Northeast, but then they may pull from Equifax if you're in the Southeast or if you're in the Southwest. So you have to ask, based on your specific situation, you have to ask the banks and credit unions, okay, where do you pull from for my particular state, my particular region, etc. Now, you want to build with banks that have personal and business products as you're developing your 7-figure portfolio, because if you start on the personal side with an institution and then you develop this relationship with them, you build with them 3, 6, upwards of 12 months before you even graduate to the business side, they already understand you as a consumer. They understand your spending habits. They understand the ebbs and flows of your business, whether you are co-mingling personal and business funding together or however you're operating in your financial journey. But the primary reason why you want to build with institutions that both offer personal and business products is because you are building internally with them. Not to mention that we have a play that we do when we can reallocate over from the personal side to the business side. But I just want to make sure that y'all understand the basic concepts of structuring a 7-figure portfolio, family. Now, multiple reasons why you want to build with them outside of, once again, just developing an internal relationship, but the reallocation play. This is clutch right here, family. So let's just say that an institution offers 2 or 3 personal credit cards. American Express is a prime example of this. You can go to American Express and you can start out on the personal side, which is highly recommended. You develop a personal relationship with them. You build out. You let them see how much you can spend on a month. And once again, we could be leveraging manufacturer spending. It's a multitude of things that we could leverage to build out our internal banking relationships. But more so than anything is that if they have multiple products on the personal side and multiple products on the business side, one of the reasons why you want to build with this particular institution is that you can do what they call a credit limit reallocation. So if you get a $10,000 credit card on the personal side, and from here, what you're able to do is move the limit from your personal credit over to your business credit. So that's one of the reasons why you want to go to banks that will offer you multiple products on the personal side and business side. Another reason why you should do this is great right here. Let's just say that you go to Bank of America and you understand the application rules for Bank of America, which is their 2-3-4 rule, which states that you can get 2 credit cards within a 30-day sequence. What you can do is then reallocate the limit from one of those cards to one card, and you double the limit on that one card, shut the second card down, and then you could then go for this card later. Listen, man, that was too much. I'm getting ahead of myself, family. But this is a major loophole in the banking sector, as certain banks have rules on this. Some banks require you to have a strong relationship with them to be at least 6 months. Some banks require you to be with them for a year before they will allow a credit limit reallocation. So make sure you check with the institutions that you are building with to see if they have a reallocation and what their underwriting process is for it. So you are using creative financing to maximize the funding, family. That's all that we're doing here. And then as we understand the credit limit increase rules, because that's an important part of developing a 7-figure portfolio, is that you should know when you're available to ask for a credit limit increase. There's no good in you having a $20,000, $30,000 credit card if you're not going to, 1, use it, and 2, if you're not going to continuously ask them for more money on the existing lines that you have. The primary goal is that you want to get access to large lines on your profile. So whenever you get to the business side, banks will see that you have access to large lines, and they're going to make sure that they give you or grant you more access to more business funding whenever you develop that way. None of this means anything if you don't know what banks to go to. So let's just say that TransUnion is your strongest sequence. You can go to banks like Fidelity, Navy Federal. You can go to banks like Fifth Third. You can go to banks like BMO Harris. BHG is a great lender for TransUnion as well. Regions Bank, Alliant, Comerica, and US Bank. So if TransUnion is your best profile, these are the banks that you should be building with, or at least starting a checking account relationship with and making small deposits so you can get close to that 90-day time frame to where you can ask them for money. Now, if Experian is your strongest bureau, the Gemini card for my crypto people, that is a great card because they give you cash back in the form of crypto. Also for Experian, for credit card, PNC is going to pull Experian. You have Wells Fargo, American Express may either pull TransUnion or Experian. Discover, Barclays, SoFi, Bank of America sometimes will either pull Experian or TransUnion. So these are institutions that's going to leverage and pull your Experian profile. Now, if Equifax is your strongest profile, it's not a lot of banks that pull from them, but the ones that do, they are a gold mine. So you have Citizens Bank, you have Truist, you have Citi, you got KeyBank, you have Synovus, DCU, Langley, PenFed, TD Bank, right? First Citizens Bank. So it's a multitude of banks and credit unions that are going to pull from Equifax. But if you don't know what banks to start with, just off of this mini funding sequence that I gave you, you should be able to go and get access to your first 6 figures in funding, whether it be through TransUnion, Experian, or Equifax. You should be able to go and get access to your first 100,000 to 150,000 with the banks that I just provided to you. And listen, family, as you develop your 3-5-90 sequence, we have to understand that the longer the relationship is with each institution, the bigger the approvals. This is what we call dating the bank. We got to date the bank first, family. And it's a rule of thumb to date the bank a minimum of 90 days before you even ask for the bag from them. I say it all of the time. You can only operate in a level in which you understand the game. But I want to let you know something. There is a specific order in whenever you are developing your sequence, once your profile is structured. Now, pre-qualification banks are banks and credit unions that are going to tell you the limit that you're pre-qualified for before they actually issue you the credit card and pull your credit. American Express does this. Discover does it. Apple, PayPal, FNBO, Capital One, Truist, Wells Fargo. They will tell you if you are pre-qualified. Now, from the pre-qualification, you want to go to soft pull. Soft pull means that they can issue you credit without issuing a hard inquiry to your consumer report. Now we're going to go to new account sensitive. Banks like Bank of America, Chase, Barclays, they have pretty much internal rules to tell you if you have more than X amount of new accounts over X amount time frame, you're going to automatically be denied. For example, Chase is known for the infamous 524 rule, meaning that if you have over 5 credit cards over the past 24 months, you're going to be denied for a credit card for them. Well, Bank of America has some internal rules as well that not a lot of people talk about. So they have a 312 rule and they also have a 712 rule. This says that if you have more than 3 new accounts over the past 12 months and you're not an existing customer, you will be denied for credit. If you are an existing customer for Bank of America and you have more than 7 new accounts over the past 12 months, they are not going to issue you a credit card, right? So we want to automatically go to these banks first as they are new account sensitive. They don't like to see that you have a certain amount of new accounts over a past 6 months, 12 months, etc. While banks like American Express, PNC, Citizens Bank, for example, they could care less how many new accounts that you have on your profile as long as you have great comparables on your profile. And from the new account sensitive, we then want to go to banks that offer multi-dips. What a multi-dip is that you can walk in, pull my credit one time, and I can get access to a personal credit card, a personal loan, an auto loan, and possibly even a line of credit. So banks that offer double dip or multi-dip, these are going to be diamonds in the rough. Bank of America with their 234 rule. Chase has a 230 rule, meaning that you can't get any more than 2 credit cards in a 30-day time frame. So as you are going through, you must understand the application rules along with this sequence that I'm telling you. Now from the multi-dip, let's get into multi-entity. You said, oh, this is so good here. If you have multiple businesses, you can go to banks that will pull your credit one time and they'll issue you credit for each one of your businesses. So let's just say you have 3 different LLCs that's operating and you're generating revenue, right? You could then go to banks like Truist. You can go to banks like Synovus. You can go to banks like Citizens, right? And then you can apply for a credit card under each one of your businesses, and then they lend you money for each one of them while only pulling your credit one time. So as a quick recap, family, we got pre-qualification, we got soft pull, we got new account sensitive, we went multi-dip, which they'll give you multiple products and only pull your credit once. But then we get to multi-entity, where if you have more than one LLC, then they can issue you credit for each one of your businesses, and then you can stack them together. Now we go to low doc, right? Low doc / stated income. This is a rule that I have seen so many people talk about online, and they're essentially telling you to falsify information on credit applications, which I would never recommend anybody do, because let's just say that the bank comes through and they want to do a financial review or a financial audit. If you can't provide the paperwork to say that you actually make the revenue that you put on this application, you could possibly get all of your credit products for that institution shut down, which could drop your credit score tremendously. So whenever we go to low doc / stated income banks, the rule of thumb is to not inflate it no more than 20 to 25%. So for the revenue that we're going to use on applications, is something feasible, that's something that we can actually prove for stated income. Now, all banks will not require stated income. Some will require bank statements such as like documentation. And so stated income in no doc is projected. Now, banks is going to have a light doc requirement. These are banks is going to request anywhere from 3 to 9 months worth of bank statements. And then we get into the full doc, which is a 1-year tax return, a 2-year tax return, or even deeper than that. The bank could request to do a 4506 where they go directly to the IRS and they pull your paperwork for your business. Typically, these are with larger lines of credit, larger loans, etc. But listen, family, as you go through your journey, just understand this. We are here to make the banks compete to lend you money. And that's what we do at Reinvented Consulting. So this was another banger, family. I appreciate y'all for tapping in. And in my words, everybody eats. Let's go. Peace.